Following the remarks of Professor Taylor, we'll have another break with some more food and some more time to get to know each other. But I have this honor now to introduce Professor Taylor. My wife and I are both economics majors from Stanford, and my wife Madeline took Econ 1 from Professor Taylor. I took Econ 1 from Professor Boskins. So I enjoyed both of their courses, and my Econ 1 textbook from Professor Taylor sits on my bookshelf. Professor John Taylor is the George P. Schultz Senior Fellow in Economics at the Hoover Institution and is the Robert Raymond Professor of Economics here at Stanford. I think it's particularly interesting that Professor Taylor will be speaking to us today. He wrote an op-ed in the Wall Street Journal on Monday that discussed the Fed policy and the positives and mainly negatives of the direction of where things are going. And if you open up your newspapers today, you saw where the GDP numbers were for the fourth quarter and the stalling. I'm sure he'll have things to say about that, but it's a particularly topical point for him to discuss today, and we're looking forward to hearing from him. Professor Taylor has a book out, First Principles, which discuss the economic plan to restore America's prosperity. One of the things that I particularly am impressed with Professor Taylor, he has served on economic councils for numerous presidents and has done much with international policy and treasury departments, but he's received extensive awards for his undergraduate teaching and has always been a favorite teacher of many of our undergraduate students here. I could go on and on about Professor Taylor, but I want to save time for him and invite Professor Taylor to come forward.
Is it working? Thanks very much. Yeah, thanks for inviting me. Pleasure to be here. As you see from the title, I want to talk a little about economic policy and where we are now, and especially given the start of a second term of President Obama and what I think is going to happen. I want to start with a kind of a broader perspective on the economy, and I'm going to use charts. I mean, economists love charts. Not everybody loves charts, I realize that, but so bear with me if you don't, but I think it's the easiest way to get through this. And I'll try to be brief so that we can have some little discussion before we have to stop. So this is my broader perspective. I know it looks like an EKG, but what it is the growth rate, quarter by quarter, in the US economy, as you can see going back to the 1940s. And on the graph, there's this period which is relatively stable, I'll put it that way, not a lot of volatility. If you look closely, the graph has a zero line. When the growth rate goes below that, especially for an extended period, that's called a recession. And by the way, we just learned this morning that the red line, it's not on my chart yet, the red line went below zero in the fourth quarter of last year. And so that doesn't mean a recession, but it's certainly in that territory. If you look at this, that's the Great Recession. That's the so-called recovery, which has been weak from the start, and that's a real concern to me. In fact, the minus 0.1% growth in the fourth quarter of last year, to me, kind of a continuation of low growth since the recovery began. And economists define recovery as the period following a recession. The recession ended in the summer of 2009, so the recovery began then. Usually you have much faster growth, especially after a deep recession. And that's the growth rate we had in the recovery in the early 80s, after you can see equally deep and serious recessions in the late 70s, early 80s. And so this is a concern. There's other ways to look at this, just to emphasize a little more. Sometimes this is the GDP itself, not the growth rate, so it looks like how much the economy is producing each quarter. It's going quarter by quarter. It doesn't go back to the 40s. It only goes back to the beginning of 2007. And you can see the recession. It went down. That's what a recession is. GDP falls. Growth rates are negative. And you can see the recovery. That's the recovery. So there is a recovery, just like President Obama said in the inaugural address. Recovery has begun. But it hasn't brought us back to any reasonable estimate of the economy's potential based on the labor force capabilities, on its productivity. And so that gap, you can see, is really what the problem is. That's why unemployment's remained high, and that's why many of us are still concerned about the US economy and what's happening. Just by way of comparison, that's what happened in the early 80s. In that expansion, there was a gap of equal size, basically, but over the same span of time, it really got back to normal much more quickly. So we're languishing. And that languishing has implications for the labor markets. I wish there was more discussion in our country about the high unemployment and the problems of the labor markets. It's like we're forgetting about it. This is a picture of the fraction of the labor force, the fraction of the work 16 and over that is working. And it compares the months in this expansion with the expansion in the early 80s. So the blue line is this expansion, and the early 80s is the red line. And it's the change in the percentage. And so you can see we've had some job growth in this recovery, but it hasn't even been enough to catch up with the growing working age population. And so we really haven't even taken off yet in the sense that we have to improve the labor markets. So this is a concern. When I say that I'm concerned that people aren't talking more about the unemployment problem, I'll give you an example. In San Francisco, the unemployment rate is 6.7%. It's 7.8. California, it's 9.8. In the Central Valley, Fresno, Yuma City, et cetera, it's about 15%. If you go to Southern California, El Centro, it's about 29%. My first job in Washington was in the 70s in the Ford administration. And towards the end of the Ford administration, Greenspan was the chairman, so I was working for him. We decided it would be a good idea to redefine the normal unemployment rate. At that time, people said 4% was normal. We said, well, that's really stretching things. We think it should be 4.9. Sounds like gasoline pricing, but we thought the 4.9 was a more reasonable estimate, just to be sort of sober about it. So we went to the Joint Economic Committee, then chaired by Hubert Humphrey, strong Democrat, liberal, ran for vice president, and he was outraged. He said, you know, if there was a plague in this country, and you economists were doctors, you'd redefine the definition of normal temperature. Sort of put us back in our chair a little bit. 6.7, 4.9, and we like 6.7 is okay, you know. So we really have to, I think, get back to the concerns about what's going on. Now, there's lots of theories about why the recovery is so slow, and part of them get partisan. But when I look at history, I see that the recoveries from deep recessions with financial crises, and frequently when housing has taken the brunt of it, have been much faster than this recovery. So there's a little bar chart to show that. The green bars are the growth rates following what economic historians define as recessions associated with financial crises. The blue line is the average of those growth rates, and the red line is our current growth rate. Okay, so that sort of should really just defeat the idea that you have to have slow recoveries after deep recessions or financial crises. It's not true, historically. Another sort of piece of evidence there's something going on here. This is the forecast that the Federal Reserve Open Market Committee, the body that decides on interest rates, had for this year, 2012. So just in early 2011, they were forecasting 4% growth for this year. And then they gradually have ratcheted that down. It's turning out to be about, with the bad numbers in the fourth quarter, about 1.7%. So it's less than half what they were forecasting. So this is, again, another indication of something going on. People always ask about housing. You're obviously thinking about housing. And obviously that's been a factor in this downturn and perhaps in the recovery, but it's not as much as you think. This is a picture of housing starts, total private, seasonally adjusted annual rate in thousands, and you can see the huge bust in construction of housing, and then the recovery. Of course, the recovery has started out weak of housing, but it's actually been pretty good in the last year and a half, measured in total starts. But the whole economy has not picked up, and so it's not simply, a lot of people would like to think of it this way, just we're recovering slowly because of weak housing. For a while, maybe that was the case. It just doesn't seem to be the case right now because that's picking up. Another picture of that is just to look at the growth rate of GDP. That's, in this case, the red line. Okay, and so that's going to have dipped down below zero now. It's not there in my chart. So that's a pretty good negative number. If you imagine putting a minus 0.1 on the blue line for the most recent observation, and I couldn't do it, just came out this morning. You see the Great Recession. The red line is just accounting for how much residential construction, because it's part of GDP, what you're putting in place when homes are constructed, that goes into GDP. It's how much of that change had to do with housing. And you can see the housing was a drag but not as, it certainly couldn't cause the whole deep recession. It was a drag. It was below zero, maybe about -1 of the contribution. And it's been pretty neutral, and you can see just recently it's been picking up, but it's still very small total. So it's, housing is important, it's more volatile, but as a contribution, I don't think it's the whole story. So as a result of going through all of these possible explanations, I've come to the conclusion that unfortunately what's going on is mainly our policy that's the problem. That's my view, not everybody's view, obviously. And I think of the policy problems related to our fiscal policy, our monetary policy. I wrote a piece yesterday in the journal about our monetary policy, but also our regulatory policy, actually across the board. And this is a phenomenon I've noticed for many years. When policy goes sour, it goes sour in almost all dimensions. When it gets better, it seems to get better in all dimensions. And so I look at the 80s and the 90s until recently as pretty good, fiscal, monetary, regulation, et cetera. When I look at the 70s, I see those were all bad. Monetary policy was terrible. We got the high inflation rate. Fiscal policy, we tried all sorts of things. We had wage and price controls with Nixon. How bad could it be? And then recently, I think it's gone sour in many dimensions as well. So the first dimension is fiscal policy. And this is a chart I like to use to illustrate that. It's simply the debt, federal debt, held by the public as a percentage of GDP. So it's a nice measure of how serious our debt problem is. It goes back to the founding of our country, so that's the late 1700s. And you can see it's basically gone up during wars. What used to be the gigantic increase on that blue line, for most of my career, I talked about the gigantic increase. And now it looks like a pimple in World War II. And the history continues. And then the rest of it is a projection. And it's a projection based on current policy continuing. And so we hope it doesn't happen. In fact, if it does happen, the United States of America will not be the United States of America anymore. We couldn't possibly pay debts 600 or 700% of GDP. So the CBO, reliable organization, estimates what's going to happen to the debt as we borrow and borrow and borrow if policy does not change. And that means spending policy or tax policy, whatever you want to think. Now, that's the 2009 projection up there. So you may say, oh, have things got better since 2009, Professor Taylor? No. The red line is their most recent projection. The only thing they've done is cut off at 250. So I don't know if that's like a solution to the problem. No, they're not reporting numbers that go above 250. But you can see it's otherwise almost exactly the same. And if you continued it as it's not that hard to do, the line is the same. So nothing has happened in this period of time. We're hoping it's going to happen, but not yet. I want to give you another rough measure of the concerns I have on the regulatory side. And this is hard to measure, as you know, but this is simply the number of federal workers employed in regulatory activities across the board, financial, environmental, social, economic. It excludes TSA employees. It would be much more if it was TSA employees, of course. So it's rising. This is what it looked like in the early 80s. It was falling. I mean, it was lower, but put that aside. It was not increasing. So there's a difference there. And I think, obviously we need regulations. Part of this is the financial market regulations. But that's a drag, going to be a drag of some kind on the economy. So I count that as well. This is another amazing statistic for those involved in taxes. This is the number of provisions in the U.S. tax code that are to be renewed each year. In other words, expiring provisions by a certain date. So the cliff was an example of that. And it's increased. The years that are missing is because the Congress didn't the congressional staff didn't tabulate it. But that's also increasing. So that's kind of a measure of tax uncertainty, because you know, if a provision is expiring, it means you don't know what's going to happen, what the Congress is going to do. You might have a guess. A lot of people make money guessing, but that's another measure of the problem on the regulatory and tax side. Let me take a few minutes to say, at least on the fiscal side, what I think should happen. The fiscal cliff already raised taxes, and I'll try to show that in the diagram. But this is a picture to show you kind of the problem over the next 10 years. The House promised to put a budget out which is going to balance in 10 years. So this is a picture of, goes to 2021. It starts in 2000, and it's now federal spending as a share of GDP. That's a pretty good measure of kind of the size of government, or what it takes to run the government. You need to have taxes to pay for that, otherwise you run a deficit. The history is in blue, and you can see is in 2000, last year of the Clinton administration, spending was 18.2% of GDP. It rose during the Bush years. By the end of the Bush years, let's say 2007, in the picture it was 19.7. And then it skyrocketed up, to some extent because of the stimulus package and other kinds of spending that occurs in a slump. And the red line is what President Obama proposed in February 2011. So that was before all the controversy about the debt limit in 2011. Okay, so that's kind of, I think, of the starting point. All the discussions about the budget agreement in 2011 brought that down. So when the president and others say we cut $1.2 trillion out of spending, that's that gap. Okay, it's compared to what he proposed to what actually happened. This is what happens if we did what Simpson-Bowles proposed, which actually, by the way, is very close to what the sequester would do. Sequester took more spending out, and there's a real question whether that's going to happen. But even there, you have spending 22% of GDP, which is way above where it was in 1980 and where it was in 2007. I'm sorry, above 2000, forget 1980, above 2000 and above 2007 levels. So to me, the answer to this is to simply get spending down. I say simply get spending down to where it was before the problems began, before our crisis began. And remember, this is a share of GDP. Since GDP is larger, spending is not being cut, it's just growing at a lower rate. And I think this is doable for many reasons. It's basically, if you like to think about it as a particular government agency, if they were doing okay in 2007, maybe their budget has exploded since 2007, but what's the deal? Can't you survive at 2007 levels, even including the inflation rate coming back? And so to me, this is doable, and I think that's what the House has to do, something like this. And by the way, this is all it takes to balance the budget, because roughly speaking, there'll be enough tax revenue with the current law to bring tax revenue up to close to that green line. So it can be done with spending. That'd be my preference. Certainly rather do more tax increases. I mentioned I would show you what the tax increase did as part of the fiscal cliff. That raises revenue by 0.3% of GDP over this time. So 0.3 is, you can see the little marks are 1%. So it raises it by a third of one of those. So it would be like maybe from 18.5 to 18.8. And so it's not even close to dealing with the problem. And that's just the facts. I think that's why you're hearing more about having more taxes. Okay, let me just say a word about monetary policy. I'll skip over some of the other budget things. And because I think this is an interesting thing to me. It's basically been my field of research for many years. There's a lot of confusion about what's going on. That's what I wrote about in the Wall Street Journal yesterday. Okay, this is one way to think about the unusual nature of our current monetary policy, how unprecedented it is. It's a measure, it shows you the reserves, or basically deposits, that banks hold at the Federal Reserve. So just like you hold money at a bank, banks hold money at the Fed. And in order to help the markets when they're in stress, the Federal Reserve always increases reserves. It's basically provides liquidity, if you like. And so you can see, this chart goes to 2000, and this is the amount of these reserve balances that the banks are holding at the Fed. And it's generally been very small, so 10, 15 billion. In 2011, in 9/11, the terrorist attacks, it jumped up to unprecedented levels. That's 60 billion. That little thing you can hardly see, that's 60 billion. I was in the government at that point. I thought it was the most beautiful monetary operations ever. It went in. You had physical damage in the financial markets to provide that liquidity, and then it came out very quickly, and it went well. The next blip is the same kind of action taken during the financial crisis. So this is really largely in the fall of 2008, mainly October, November. And so again, another big infusion of funds, and I think basically that was fine. You didn't know what was going on at the time. The Fed did that, give them a lot of credit for trying to arrest the downturn. But what happened after that is not this, which you might think, well, they provided the liquidity, the panic was arrested, the stock market stopped falling, you saw a return to some stability, so you remove that, just as you did in 9/11. But that's not what happened. This is what happened. And that's because of all these quantitative easings. They now are not providing these reserves just for liquidity. They're financing the purchases of mortgage-backed securities, of treasury bills, by effectively crediting the banks with all this. Most likely this line is going to increase a lot because the Fed has restarted with sometimes called Q infinity purchasing of mortgage-backed securities and treasuries at 85 billion a month, and so that line will most likely continue to grow after falling short. So I think this is a problem too for the economy, because at some point this has to come back down. The reason it has to come back down, simply put, is all that extra money floating around the banks drives the interest rate to zero. Okay, the interest rate's zero. You know that. Fed wants it at zero. But if they want to raise it, in some sense they have to get that back to supply is down. So the supply and demand for money create a higher interest rate. Reduce supply, you raise the interest rate. So there's a gigantic amount that has to come down. Now they're hoping they won't have to bring it down too rapidly, because when they bring it down, they're going to be selling those MBS. They're going to be selling the treasuries. And so that could be a concern, especially if it's too fast. And so what they're hoping is they may just get the rate to go up by paying interest on reserves. Okay? But you can see, at least just see how unprecedented this is. This is not your grandfather's or father's or even your older brother's monetary policy. And so that's a concern to me, and I could go into that if you like. So I would say, all in all, I'm concerned about the economy for these reasons. I think fixing it, from an economic perspective is not hard. It doesn't seem like a lot of interest in fixing any of these things right now. There's not going to be any change at the Fed for a while. Most likely the next chair, if there is a next chair, or if Bernanke continues, they'll continue with this policy. I worry that our fiscal stuff is not going to get the correction it needs. So far it hasn't, as you can see from my charts. And I don't think as much on the regulatory side, it's a real, what do you think of Dodd-Frank alone, all the extra rules that have to be written haven't been written yet. So it's a real struggle, and I try to be optimistic and think of various strategies, and actually, since I'm kind of in the game, talking and doing work, I can't help but be a little positive. If you're in the game, you don't want to say we're going to lose, right? So I'm positive about it, but it's going to be a struggle. And let me stop there for any questions. Thank you. Yeah?
On that spending chart, why didn't you show revenue? Why didn't you show the gap? Is it too depressing, or one where you had, here's the current spending plan, and here's Symposium, here's me?
Gap between that and revenue?
Yeah.
I guess The graph is cluttered enough as it is. It would be, I mean, if you want to, you could put a estimate of where revenues will be in 2020. You could also have revenues, as the spending went up, revenues went down in the recession, and they're projected to go up, so.
And the reason I ask is
yeah.
because a lot of the discussions now are about a perpetual gap between, the best talks are 21% spending percentage of GDP, and revenue, no one's talking about anything greater than 19%. So it's kind of a perpetual, forever gap.
Well, I think that's because people figure you're never going to get to the green line. So that's the reason. They figure we're never going to get to the green line, so we can't raise getting taxes to be 22% of GDP. I mean.
But you started this by saying the problem is policy, right? And it wasn't so long ago. I mean, you had a Democratic president, Clinton, and you had a Republican, that they weren't so far off. So why is it so different?
Well, there's a lot of interest in keeping spending high. It's, just think about it. It's my green line in a political debate would be considered draconian, unreasonable. You're gutting all these programs. I mean, you know what it's like. I certainly know what it's like. And so there's a real demand out there, and maybe, I mean, this is a debate that should be happening. But Simpson Bowles, which a lot of people say was great, still would have to have a big tax increase. And that was part of this tax reform. They were going to lower rates, expand the base, but by enough that would raise revenues as a share of GDP. Good question. I think, I think actually charts like this help. When people say 1.2 trillion, we cut 1.2 trillion, we're going to cut 4 trillion, I don't think anybody, it doesn't mean much to me even. Also, we're now going to take a near-term year off our 10-year window and add a year at the end, right? It's going to be 2013 to 2023. That will change all these numbers just because the out years are so much different than the in years. So it's really, it'd be good if people paid attention to charts like this, I think. Yeah.
Did you ever do any analysis on the change from the employment rate to the actual exported jobs to, say, China?
So a change from what? Yeah, why don't you use the mic?
Do you ever do analysis regarding the transfer of employment from the United States to abroad, to China, for example? Typically, you pointed out in each previous recession, you had a spike back up in productivity as people went back and hired the old workers back. But now you have a fundamental change in the economy because the workers are no longer here, so the workers that have been laid off have been replaced abroad. So I don't understand how you account for that spike in one fundamentally as a part of policy, which is not a policy issue per se, fiscal policy that is.
Well, I don't think that's the problem. When people looked at it, you can't attribute much to that. I know I probably try to explain myself a little bit, but it isn't like China just appeared. It isn't like low-wage labor abroad just sprung up in the last 3 years or 4 years. So it's to me a question of just job creation right here. If there are people who are not employed and there is growth, they will be employed. Another way to think about it, maybe this will be more convincing. Our growth rate is low. Less than 2% last year. So you just are not going to generate many jobs at that low growth rate. So I don't see how you could have...
I agree with that premise, but you also have another fundamental problem as well. The banks are basically hoarding cash and they're not lending to these businesses which would be growing jobs.
That goes back to my monetary policy critique to some extent. So I think to some extent, this may sound counterintuitive, but it's the point I tried to make in the journal yesterday. The Fed is now not only having zero rates short term, it's promising zero rates short term out into the future, 2015 or something like that. Depends on the unemployment rate, but 2015. And so what that does is make other longer rates lower, drives them down. That's why the Fed is doing it. You think of a term structure of interest rates, it's driving them down. Well, if you think about maybe the 3-year loans or 4-year loans, they're basically been driven to zero by this policy. But most likely, the equilibrium in that market is higher than 1 or 2%. And so effectively, I think of it, those promises, which hold rates down, are almost like a price ceiling, like a price control. And if banks, if you're a bank and you're thinking about lending, if you're borrowing, hey, this is, maybe most of you are thinking on that side, you're borrowing, this is great. Mortgages look good, a lot of, if you're doing it in great shape, but banks are, I think, reluctant to lend for that reason, maybe others too.
But I think you also need to address the fact that a lot of banks are insolvent, and they cannot lend because of their reserve requirements that they have, number one, and number two is that they should have been taken over.
Well, the reserve requirements are not a problem because they have so much excess reserves, but there's definitely concerns about capital, absolutely. I'm not saying my explanation is the only thing. And, but so you also have, corporations sitting on huge amounts of cash too, so that's not really a banking problem. I would say that's the uncertainty, that's the policy uncertainty, that's the other things that I've tried to stress.
Let's take two more quick questions.
Okay. Yeah.
On your federal spending as a share of GDP, isn't the elephant in the room on your chart the federal spending on medical care? And to get from the CBO baseline of 2012 to your alternative pro-growth budget, you're going to have to take a massive cut out of Medicare, Medicaid, which would just be shifting that spending from government to private.
Not so much as you think. The main problem with healthcare is here. Okay, so these go out into the future. This is really that exploding debt chart where you get into the exponential. This is really what that is. And I think of the blue line is healthcare spending. So that's Medicare, Medicaid, federal contributions, and Obamacare. And that's what the red line is. That's the CBO's estimate of current policy, okay? The blue line is a reform that I think would be feasible, and all it does is keep the growth roughly. It's a little bit more than GDP because you're going from, say, 5 to 6 or so, so it's a little bit faster than GDP, but it's almost all of this is coming down the road. And so the reason to get your hands at it now is it's a drag because people don't know how it's going to resolve. Admittedly, if you do something earlier, it's going to be better, but right now, no one wants to say they're going to do anything for someone that is older 55.
But the difference between the red line and the blue line would be you're shifting spending from the public to the private sphere, right? You're not eliminating that cost.
Well, don't know. I mean, do you think the federal government should be spending 12% of GDP? I mean, these are really sort of unreformed programs where very little incentive. I'll maybe give you another way to think about this. There's really not a lot of disagreement on either side on the fact that the explosion, that red line has to be brought down. I mean, President Obama has effectively laid out plans that address that. Republicans have laid out plans. So there's a lot of agreement we should bring that down because there's a lot of inefficiencies in that. The incentives are bad. You're just extrapolating law that doesn't make a lot of sense. And so there's basically two proposals, just to simplify things, two types of proposals to get that red line down to the blue line. One is the Independent Payment Advisory Board that's part of the Affordable Care Act. And what that board is supposed to do is that if spending grows too rapidly, they're supposed to suggest laws to Congress to pass to fix it. And if they aren't, they impose quantity, price restrictions. Okay, that's at the center. That is what the plan is. But it's meant to reduce the growth rate. The alternative plan, Rivlin, Ryan, Wyden, whatever you want to call it, is to have roughly the same growth as the administration, but to do it through this premium support, where amount of money equivalent would be allowed for, this is Medicare, for seniors to spend on different types of insurance, including Medicare. And so there, I think of it as an advantage because you're using the price system to some extent to allocate care, allocate responsibilities, which the center doesn't. But I don't think it's quite philosophical because I'm an economist. I think the price system works and the decentralizing is better. But it is a discussion that reasonable people can disagree about. But there's not disagreement on getting the red line down.
I think the key is if you're actually reducing the cost of healthcare or just shifting it from public to private, and if the U.S. people are paying for it one way or the other, it doesn't really help all of us if we're paying it from one pocket or another.
Okay, so almost, not all, but almost all the growth on the red there is not due to the baby boom generation retiring, more people retired. Most of it is due to more benefits per person, even in Social Security. A 45-year-old now, if I get these numbers, these are really approximate, a 45-year-old now, when he or she retires, will be getting 50 or 60% more in real terms than a person that's retiring this year. So their benefits per person are expected to increase a lot. Now, people are increasing, but you could say, well, that's something we could probably work on, you know, maybe hold that back. And I think reasonable people could come to that if they realized what it was. But I don't want to minimize any of this. It's very tough. But I think when you look carefully at the numbers and try to get away from the political rhetoric, it's easier than you think.
Maybe one last brief answer or question.
I'm sorry. Maybe way in the back there. Can I point to someone? Yeah, wait for the mic. Yeah.
When the Federal Reserve Bank is holding huge assets of fixed-rate securities, debt securities, in a very low interest rate environment, if we get 2, 3, 4 years from now and interest rates go up at all, then the value of those assets will plummet. Who eats the loss on those, on the value of all those assets that the Fed's holding?
Well, we do. The Fed does. I mean, that's a risk. The concern would be the Fed would go insolvent or something, but the Fed would lose the effective wealth from that. But in the meantime, of course, it is, you know, paying, because it has so many bonds, it's turning back interest to the government a lot more than usual, right? Because its portfolio of bonds is roughly like that line I just showed you. So what they will argue, yeah, maybe even if we're insolvent in the sense that our assets have declined compared to our liabilities, we've already, you know, sent so much to the taxpayer, we're okay. So I don't think that part is as much a concern as the following. When interest rates rise, if they don't reduce that balance sheet, they're going to have to find another way to raise interest rates. They have to raise them at some point, unless we're perpetually at high unemployment. And the mechanism that they are planning to do, and if they can't sell all these securities off, is to pay interest to the banks, so that you raise the interest that way. You raise the interest rate. But, you know, that means if it's $1.5 trillion in reserves, 2%, just 2% interest is $30 billion a year going directly from the taxpayers to the bank. So people say, how is that going to actually happen? And I think that's a real question that would hold them back about doing that. Also, it's a little, if they want to sell off these securities, we don't know how that will impact the market. Obviously, they bought them trying to hold rates down. Selling them, you might think, would bounce the long rates up a lot. Monetary policy is always difficult to exit when the economy shows some strength. I mean, easy policy is hard to exit. The raising interest rates is hard. But in this case, they not only would have to raise interest rates, they have to sell this huge portfolio. And so both the timing, accuracy, all those things will be very hard. And that's a worry I have about down the road, which I think impinges on what's happening now.
Thank you, Professor Taylor.
Okay.
I'm sure you have lots of other questions, but appreciate Professor Taylor's time. Thank you so much.